All right, why don't we switch gears and talk Spotify? Market was happy with Fitbit's results. Not exactly the case for Spotify. We saw a pretty big sell-off after earnings, and the company's actually down to lows since they've gone public. This is the lowest we've seen shares.
Yeah, the investors weren't too happy with Spotify. I think part of it was their guidance, but as far as the results for this quarter goes, revenue came in at about $1.5 billion. Premium subscriptions are continuing to grow. So now they're at about 87 million premium subscribers, which is by far the biggest premium paid subscriber base in the world in the music streaming industry. We've talked about Tencent before, but Tencent, as we mentioned on other shows, is most of their users are free users and they're not actually subscribing. So Spotify is by far the market leader here. They were actually profitable, but that was kind of a one-off occurrence and actually related to Tencent Music. They had a tax benefit related to a mark-to-market adjustment regarding the value of Spotify's stake in Tencent Music. If you remember, they did an equity swap last year, and when Tencent Music filed their filings to go public, there was a lot of information in there that basically warranted them making some adjustments. So that's where their tax benefit came from. So that's not like a regular occurring thing. And they actually they lost less money than they thought on an operating basis, which they actually considered a negative thing. Like they said, we should have lost more money.
Right. This is a company that is very much in growth mode, and they are expecting to spend a lot of money, particularly on the hiring side, in the R&D element of their business. So they were disappointed that they couldn't spend more and bring more people on. That's right.
Right. And, so basically their operating margin improved. They still lost money on an operating basis, but they said that, we should have lost more. Like we didn't hire as many people as we wanted to. And that's also continuing into the fourth quarter, which is also kind of why they adjusted their guidance. So their guidance for as far as their financials go, they're actually now expecting to lose less money than they had previously forecast, which again, they consider it's a bad thing because they know that they need to be reinvesting very heavily into this business to really keep growing, and profitability will come later.
Yeah, you mentioned the guidance, and I think you're right. I think that's why we're seeing the sell-off today. The reality is they've gotten bitten by their own optimism. They put out some improved guidance last quarter looking at their full-year outlook. They revised all of that back down to what they were originally expecting at the beginning of the year. It's not that there's a huge reset going on. We're talking about a difference of 1 million premium subscribers one way or the other. All told, Evan, how are you feeling about Spotify? You are a shareholder.
I still think it's a good company for the long term. I still believe in where this company's going. And yeah, I do think this market reaction is kind of an overreaction because it's just minor adjustments to their premium subscriber outlook. And like you mentioned, it's like 1 million subscribers one way or the other. That's not the kind of number that's going to make or break this company. And investors, selling off the stock, I think is kind of silly because we're just going back to the guidance that they issued earlier this year, which is still strong guidance. They're expecting 93 to 96 million subscribers at the end of the year, which is, again, they're by far the biggest paid streaming service out there.
Yeah. And if you are buying into the long-term vision of this company and you're thinking, all right, music streaming is the future, this is one of two companies that are extremely well positioned to capitalize on it in the US and in Europe, some of the big markets. Well, 1 million in 1 or 2 quarters shouldn't make a big difference. The addressable market for these types of services is so much bigger than that. And the larger opportunity is so much bigger. So I wouldn't get too swept up in the individual guidance figures from one quarter to the next if that's the narrative that you're buying here.
Right, exactly. I'm still confident. I'm hanging on.
I think this, too, is a pretty good lesson in dollar cost averaging on some positions. We've talked about some recent IPOs. We've done some deep dives, and it's really easy to get excited when you first have an opportunity to scoop up shares of a company that you've been following for some time. And I think that this movement that we're seeing is very typical, really, for a new issuance. And, we're still within the first couple reports of Spotify as a publicly traded company. And I just take all of this as a reminder to why it's so important to buy into positions over time, to dollar cost average, because there are going to be lumps with companies as they report. The market's going to take their lumps as well, as we're seeing over the last couple months. And you don't want to have a cost basis that is tied to one particular point in time. You want to benefit from those movements and kind of work down to, ideally, a lower cost basis on your position.
Yeah, especially IPOs. All IPOs are just so volatile and risky in the first, year or so. As the market's trying to figure out, what is this company worth? Take some time.